Mastering the Flow, a small business guide to financial control by avibusinesssolutions.com. A busy week can quickly expose a business's weaknesses. Payroll hits on Friday, a supplier wants payment now, card sales are still settling, and a strong sales month still leaves you short on cash. That gap is exactly where what is small business finance becomes a real-world question, not just a textbook one. Small business finance is the system of managing money in a business so it can operate, cover expenses, handle risk, and grow. It includes how a company brings money in, where it spends it, how it borrows, how it plans, and how it keeps enough working capital on hand to stay in control. For a small business owner, finance is not separate from the business. It affects hiring, inventory, marketing, equipment expansion, and whether day-to-day operations stay smooth or become a scramble. What is small business finance and why it matters? At its simplest, small business finance covers the financial side of running a company. That means revenue, expenses, profit margins, cash flow, financing, credit, budgeting, and financial planning. If operations are the engine, finance is the fuel system. For small businesses, this matters more than many owners expect. A business can be profitable on paper and still run into trouble if cash is tied up in unpaid invoices, seasonal slowdowns, or rising costs. That is why finance is not only about making money. It is about timing, flexibility, and access. Good small business finance helps owners answer practical questions quickly. Can you afford to hire? Is now the right time to buy equipment? Should you use a loan, a line of credit, or cash reserves? Can your current payment processing setup support faster cash flow? These are decisions that simultaneously shape growth and stability. The core parts of small business finance. Most small business finance comes down to a few interconnected areas. Cash flow is the priority. This is the movement of money in and out of the business. Many businesses fail because they run out of cash, not because demand disappears. If money comes in too slowly while bills are due now, pressure builds quickly. Budgeting comes next. A budget gives structure to spending and helps forecast future needs. It lets owners plan for payroll, rent, inventory, software, taxes, and marketing without having to guess each month. Financing is another major piece. This includes business loans, lines of credit, equipment financing, merchant cash advances, and other funding solutions. Financing gives businesses a way to bridge short-term gaps or invest in opportunities without waiting months to build reserves. Credit also matters. A strong business credit profile can improve financing options, reduce borrowing costs, and create more negotiating leverage with vendors or lenders. Newer businesses may rely more heavily on personal credit at first, but over time, separating business and personal finances becomes important. Payment systems play a bigger role than many owners realize. The way a business accepts payments affects customer experience, transaction speed, fees, and the time it takes for funds to become available. Better payment processing can improve cash flow without changing sales volume. How small business finance works in practice. In real operations, finance is a series of decisions rather than one big strategy document. A restaurant might use short-term funding to replace a failing freezer before inventory is lost. A contractor might need a line of credit to cover materials before client payments arrive. An online seller may need financing to stock up before a high-demand season. That is why small business finance is rarely one-size-fits-all. The right approach depends on the business model, stage of growth, margins, revenue consistency, and urgency of the need. A newer business often focuses on startup costs, basic budgeting, and getting enough capital to operate. A growing business may shift toward expansion financing, payment optimization, and stronger forecasting. An established business may use finance more strategically, choosing tools that improve speed, preserve cash reserves, or support larger investments. Common types of small business funding. When people ask what small business finance is, they are often really asking about funding. That makes sense because access to capital is one of the biggest pressure points for business owners. Business loans are one common option. They can work well for larger planned expenses, especially when the owner knows exactly how much capital is needed and what the return should be. The trade-off is that approval standards, timelines, and documentation can vary. Business lines of credit offer more flexibility. Instead of receiving one lump sum, the business can draw funds as needed up to a set limit. This is useful for managing uneven cash flow, emergency expenses, or short-term operating needs. Short-term funding can be a practical fit when speed matters. If an opportunity or expense cannot wait, faster access may be more valuable than chasing the lowest possible rate. That said, convenience and speed should still be weighed against total cost. Equipment financing may be the right fit when the purchase itself helps generate revenue, such as a truck, kitchen equipment, or production machinery. Matching financing to the asset can help preserve working capital. No single product is always best. The smart move depends on how quickly the funds are needed, how predictable the revenue is, and whether the money is being used to fill a temporary gap or support long-term growth. What lenders and providers usually look at. Small business owners often assume that financing decisions are based solely on credit scores. That is only part of the picture. Providers may look at time in business, monthly revenue, cash flow trends, industry type, existing debt, and bank activity. Some products are better suited for newer businesses, while others favor companies with longer operating histories and stronger financial records. This is why preparation matters. Clean financial statements, organized bank records, a clear use for funds, and accurate revenue reporting can improve both speed and approval odds. In many cases, better financial organization leads to better access. The difference between profit and cash flow. One of the biggest misunderstandings in small business finance is treating profit and cash flow as interchangeable. They are connected, but they are not interchangeable. Profit is the amount remaining after expenses are subtracted from revenue. Cash flow is about when money actually enters and leaves the business. A company can show a profit for the month and still struggle if customers pay late or if inventory costs exceed sales before they are collected. That distinction matters because many financial problems start with timing. Owners who monitor cash flow weekly, not just monthly, tend to spot pressure earlier. That gives them more options, whether that means tightening expenses, adjusting terms, improving collections, or using financing strategically. Why payment processing is part of finance. Payment processing is often treated as a separate operations issue, but it directly affects financial performance. Deposit speeds, transaction fees, hardware setup, and customer payment options all influence how money moves through the business. If your customers want to pay by card, mobile wallet, or online invoice, your system needs to support those payment methods without creating delays or unnecessary friction. Faster, more reliable payment processing can strengthen cash flow and reduce missed sales. For merchants, that is not a side issue. Is part of the finance strategy. How to strengthen your small business finance position. A stronger financial position usually starts with visibility. Know your monthly fixed costs, your average margins, and your slowest paying revenue sources. If you do not know where the pressure points are, you cannot fix them quickly. It also helps to separate emergency funding from growth funding. Covering payroll during a temporary dip is different from financing a second location or a major equipment purchase. When the purpose is clear, the right funding solution becomes easier to identify. Build flexibility where you can. That may mean improving your payment processing setup, keeping access to a business line of credit before you urgently need it, or tightening your billing cycle so receivables come in faster. For many owners, speed matters as much as cost. Waiting too long to solve a cash need can create more expensive problems later. A practical provider like AVI Business Solutions can help businesses access funding and payment solutions built around real operating needs, not theoretical ones. What small business finance really comes down to. Small business finance is about control. It gives owners a way to manage uncertainty, move faster when opportunities show up, and avoid getting boxed in by short-term cash pressure. The businesses that handle finance well are not always the biggest or the most complex. They are often the ones who know their numbers, understand their options, and act before a small issue becomes a serious one. If your business is growing, stretched, or simply trying to stay one step ahead, finance is not back office paperwork. It is one of the tools that keeps momentum on your side.
Running a small business means being ready for anything. But what happens when the big banks say no? At AVI Business Solutions, we say yes.